Today was the first business day since Silicon Valley Bank collapsed on Friday and since Signature Bank collapsed yesterday. Regulators placed Silicon Valley Bank under a receivership after a quick series of portfolio losses and attempted stock sales caused many account holders to panic. The FDIC then stepped in to try to prevent any further damage.
Then last night, New York regulators closed the Signature Bank, the second major failure in days. The SVP collapse was the second largest bank collapse in U.S. history. Signature was the third largest. To help us understand what happened and the impact it could have here in Michigan is Nick Manis, a banking and real estate reporter with Crain's Detroit business. Thank you so much for joining us tonight.
Thanks for having me.
And I think everyone watching tonight wants to know, just flat out, should they be worried whether they have money with these banks or not?
I think the simple answer is no. As we talked about, the regulators and the federal government last night stepped in and basically said that all those deposits are insured. And so far, despite that, it was a bad day to be a bank stockholder, but the banks themselves, it's pretty much business as usual based on the people that I spoke to today. So by and large, I think, you're pretty safe at the moment. There's nothing to indicate that your money is at risk.
So is that just based on assurances from the federal government? How do we know that this won't turn into a bigger panic and potentially a bigger crisis?
Sure, we don't know that for sure. Everything was fine, last week up until it wasn't at Silicon Valley Bank and then Signature Bank as well. But I mean, but by and large, this does not appear to be like 2008. The basic fundamental structure of the loans out there that banks do every day appear to be sound, and the banks themselves are well capitalized, something that wasn't quite the case in 2008. So while everybody is certainly getting some reminders of what happened then, by all appearances, this is not that.
I was reading this at the 5 regional lenders in the U.S. with the biggest chunk of uninsured deposits. Among them are Comerica, with $45.5 billion uninsured deposits. Mm-hmm. Is that a concern? I mean, that is a bank that started here in Detroit.
It is. Comerica had a bad day today. Their stock got absolutely pounded. I didn't see exactly where it wound up, but it was definitely not having a good day. But yeah, I mean, most banks have a lot of uninsured deposits. Most people don't have their money spread out over multiple bank accounts, and as we saw with Silicon Valley Bank, most people there had way more than the $250,000 that the FDI insures. So, by and large, it's not uncommon for banks like Comerica or others to have, a lot of uninsured deposits. So could it be a cause for concern? Certainly, but right now I don't think that that's what we're seeing.
You've already pointed out how this differs from the 2007 to 2009 period. What lessons were learned back then?
Sure. I mean, I think there was the Dodd-Frank regulations that were put in place that, some people love it, some people hate it, I suppose. But, I think that is one element that might help us here as we encounter some bumps that are happening right now. Obviously, a period of raising interest rates is really what brought upon the collapse of Silicon Valley Bank, and the fact that they were so heavily focused on one sector, which is the technology sector. And right now, the technology sector is really struggling amid these rising interest rates. Banks like Comerica, Huntington, all the ones that we see here around Metro Detroit, they are not heavily focused in just one sector. They're big, diversified banks that might have some exposure to the tech sector, but they're also having in manufacturing, agriculture, to take your pick, that aren't as impacted by the rates that we're seeing that are hurting the tech sector.
Well, people shouldn't be worried about their money that are living here in Metro Detroit. How does it affect people here in Michigan?
Well, I mean, Silicon Valley Bank did not have any branches here. They were not a branch-heavy bank. Certainly, we have a growing tech sector here in Michigan. And I spoke with some venture capital investors today who had portfolio companies that were having trouble accessing their money over the last couple of days. They said that those companies are, as of this morning, were able to start accessing their money again. So that is one impact that, Silicon Valley Bank was a key part of the tech ecosystem, which is a growing, sector here in Michigan. And certainly if it goes away, from what I understand, that is, could be, a detriment to that industry. I don't think it's going to be the death knell by any means. Otherwise, you know, the collapse of one bank, while not good by any means, I don't think is something that it says that we're, you know, heading toward, you know, anything spectacularly worse like we saw in 2008.
The government has said, President Biden himself has said, taxpayers are not going to pay for a dime of this. Does that scenario change at all in the coming days?
You know, I spoke with bankers today who said, yes, we're all going to pay for it one way or another. Quite simply, you know, this is being paid for largely by the industry, but they are going to pass those costs along to their customers. So one way or another, you know, we are going to bear those costs. And, you know, we can debate all day whether this was truly a bailout or not, but, you know, one way or another, taxpayer money is going to help, you know, get people their money who suffered because of the collapse of this bank.
Yeah.
Nick Manis, thank you so much for joining us tonight. From Crain's Detroit Business, thank you for being here. You can read Nick's reporting at crainsdetroit.com.
Thanks, Nick.